So is the intervention of the South African Reserve Bank working and suited to the needs of this country? That's being asked after inflation jumped in January. The Reserve Bank has been mandated to do its best to ensure that inflation remains within a target range of between 3 and 6%. The latest consumer price inflation number for January came in at 6.2, and it's set to rise much further.
Interest rates in a fully modern integrated economy can be an effective lever in managing inflation and other targets like the unemployment rate, a target used by monetary authorities in the US. They serve to price the cost of borrowing money. When interest rates rise, the intention is to reduce demand for borrowed money. And when they're cut, it's hoped that this will stimulate borrowing and ultimately investment into the economy. But South Africa has both a first world economy and a substantial informal one.
Every economy is different, and I think, depending on the stage of development, and the transmission mechanism of interest rates, some economies, we have lots of banks and other financial institutions, and many people who own bank accounts or are in business, and all of these things that allow people to use the interest rate mechanism. Because remember, it has to, people have to be connected somehow to the interest rate for it to actually work effectively and quickly. And so in our instance, for example, we might find a lot of people are not in the interest rate mechanism in the sense that they hold these higher purchase kinds of credit deals, and so those never change. So even if you keep increasing your interest, and some people don't even consider the interest rate for that matter, and then it might be for other people where it actually does come through, in the different kinds of flavors. So South Africa is in a particular sort of a mixed kind of economy with this very big part of it that is developed, and then another huge part that's also underdeveloped, which complicates matters.
The Reserve Bank says it can take between 12 to 18 months for an interest rate movement to have an impact on the economy. Last year, domestic rates rose by 50 basis points. But since then, the rand has depreciated substantially, resulting in higher imported inflation. And the extent of the drought has meant a surge in food prices. Average inflation during 2015 stood at 4.6%, but it's expected to be nearly 7% this year. So it begs the question whether monetary policy has been effective in recent times. Then there's the 3 to 6% target band. Many argue that because South Africa is a developing nation, higher inflation than that of developed nations is a normal reality. This suggests that the current inflation target could be impeding economic activity.
Even though nobody disregards the idea that allowing inflation to go completely out of control will be very, very damaging for the economy. But how do you make sure that you have all the right kinds of instruments? And that debate has to happen very, very strongly. We need to actually, go back to the drawing board and say, these are the things that we need. We need economic stability, we need growth, we need, obviously, price stability, and all these other wonderful things that we need to grow the economy, to create employment. But we need a drawing board in which everything is coherent and also sequenced properly.
Market players expect the Reserve Bank to inject a further 50 basis point increase for the balance of 2016, having already levied a 50 basis point hike in January. But with inflation raging way ahead of target, the reality could result in even higher rate hikes. Nampumela Losiziba, SABC News, Johannesburg.